Good morning, everyone, and welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well as we continue to ease out of lockdown. I'm pleased to have with me once again Mark Shields, investment manager from Brooks Macdonald, who will be discussing some topical issues with us. Good morning, Mark.
Morning, Brian. How are you?
Yeah, very good, thank you. Very good. Mark, we hear a lot lately about the Attenborough Effect. Sustainability, renewables, electric power, and of course this overlaps into the world of investments. How are you as an investment manager viewing these matters?
Yeah, it's an interesting area to discuss, and it's something that we as a house have become increasingly focused on, not just with the Brunsdon portfolios, but broader than that as well. And one of the things that we have or are looking to introduce in the very near future is much more of an ESG focus in our investment research, because we carry out all the research for assets that we buy in our portfolios internally. And we are now looking to put a substantial tweak on that, which integrates a robust ESG or ethical social element to it. And that would include areas such as controversial involvement in areas such as weapons, certain products, activities that companies carry out, as well as a more broader sort of carbon theme as well. Whether there are companies in the assets that we buy that are carrying out activities that aren't necessarily very favourable to the climate. And this is something that we are looking to introduce, and it is something that we think is very important for portfolios to become increasingly focused on, not just from an ethical or moral kind of level, but also from an investment level. Increasingly, we're seeing companies that do not comply with certain basic principles coming into trouble with regards to regulators, or indeed with regards to changing legislation, and this has a detrimental impact on their share price in the longer term. So we think that if we can integrate this process into our research, then we can try and flag companies that are of a concern to us and look to raise those with relevant managers as to whether it should be an area that we're avoiding, or whether it's something that we need to investigate further. So it's becoming more and more of a key part of our process when we're looking at portfolios. Obviously, it's important to note that the Brunsdon portfolios themselves do not have a specific ESG mandate. So this is not an exclusive part of our research process, but it is a part of our research process which aims to allow us to ask questions about areas that we may have concerns about from an ESG perspective. That's also to say that within the Brunsdon portfolio, we do have some direct exposure to sustainable themes. It's one of the themes we're playing at the moment, and we do have a position in both portfolios to a decarbonisation strategy, which is something that obviously is investing in companies that are very much involved in that process of the decarbonisation economies. And we think this is a very interesting area to be invested in for the longer term. We think there's a lot of money that is going to be invested in this area. A lot of large economies have declared that they're going to become carbon neutral in the next few decades. And this is we think, a very important part of the portfolios that I suspect we will continue to add to over time. So we think the whole ESG question is very important. We're integrating it both from a direct level within portfolios, but also within the research process that underlies all of the asset selection that we carry out within the portfolios as well.
Good. Okay, so it's not just a trend; it's something which is with us long term, and something that you will be working with on a long term basis. Okay.
Absolutely.
Yeah. Thanks, Mark. Okay. Let's turn now to general investment markets. I wonder if you could give us an update on the latest situation with markets worldwide, please, Mark.
Yeah, absolutely. So we've seen a little bit more volatility again recently. As I'm speaking to you today, we had some inflation data out from the US, which was substantially ahead of expectations. And what we're seeing really is a continuation of largely what we've seen for the since the start of this year, a little bit before as well, end of last year as well, is a sort of tug of war between growth sectors and cyclical sectors. And by growth sectors, I mean areas that the most common one is areas such as technology, and cyclical sectors, which are those areas that tend to do better on economic recovery. So we've seen a real kind of tug of war between these two spaces. We've seen markets coming under pressure when inflation is higher because people then anticipate that interest rates are going to go up sooner than expected. And we're seeing certain parts of the market outperform when other parts of the market are underperforming, and vice versa. And at the moment, we're seeing a continuation of that. This is something that we expect will probably continue for the rest of this year. For what it's worth, we think that the inflationary data we're seeing at the moment is what we call transitory, which means short term and will likely dissipate towards the end of this year, meaning that interest rates will not need to rise. However, that there is an expectation there in markets in general that inflation data may force central banks to raise rates sooner than anticipated. At least at the moment, where some of that data that's coming through is relatively high. It's a bit of a funny situation where actually, data that suggests that economies are recovering fairly well has actually been fairly negative, certainly for parts of the market. We think, as I said, this is something that may sort of continue for the next few months, maybe for the rest of this year. But we've very much positioned our portfolios to benefit from both those cyclical and growth parts. And when one does well and the other does less well, our portfolios should benefit from that scenario in either case. We're not trying to be too clever and second guess which way some of this data is going. And we're playing a very much more of a balanced approach to this, which I think is exactly where we want to be at the moment. And this is being borne out in the numbers that the funds are producing year to date.
Yeah, indeed. Yes, well, they've been performing very well, which we're very pleased with. Okay, Mark. Well, that's enough for now, I think. So I just wanted to thank you, Mark, for your input there, and I'd like to thank you very much also for watching. As always, if you have any questions, then please be in touch. Thank you.